That is the closing bell on Wall Street, and now it's market domination overtime. We're giving you full team coverage of all the moves to get you up to speed on the action from today's trade. Unlimited co-founder, CEO, and CIO Bob Elliott, as well as Yahoo Finance Jared Blikre is joining us here to break down the moves today. I want to start with you, Bob, on the markets. Give me your general take on today's trade. What'd you make of it?
Well, I think we've gotten a little bit of buyer's remorse from Friday. I think a lot of folks were really amped up in terms of thinking about the Powell possible.
Well, I didn't get the chance to get your take on Friday. So Jay Powell speaks. Investors decide, okay, that was the policy pivot we've been waiting for. Boom. When you saw that move in the markets, they roared. What'd you make of it?
Yeah, I think part of it was it took a little bit of tail risk off the table. Mm-hmm. There's a real question about whether Powell was going to be, let's say, forceful about the inflation side of the mandate. I think people who have been following Powell for several years weren't all that surprised that he ended up incrementally emphasizing the growth side, the labor side of the mandate. But there was a concern. I mean, look, the Fed has been above the inflation target for 52 months. They'll probably be above the target for another year or so. There was a question about whether this was the time that Powell was going to toughen up on that topic, particularly maybe to push back on what's going on in the White House and the pressure that he's facing from the White House. But he mostly just endorsed what was, a relatively dovish, labor-focused, labor market-focused Fed. I think the challenge for equity investors is that while they're sort of cheering on the idea that there might be rate cuts, what you have is a circumstance where if you get the rate cuts that are being priced in or hoped for, let's say, that's probably happening in an environment where growth is a lot weaker than what equity markets need to sustain these prices.
Jared, I want to bring you into what are you seeing at the close here, Jared? Wrap it up for us.
We ended up in the red for all three markets, not only the NASDAQ, which had been green there, but also the Dow and the S&P. Let's just take a look at some of the charts here. This is a Dow. You can see we started the day in red territory and just drifted down all day. I think this is in stark contrast, and let's do this. I'm going to put a 2-day chart on, and you can see we're still in the green over these last 2 days. Why Friday? Because that was that big Powell burst that we got off of September rate cut expectations. Now here's the NASDAQ, and you can see still holding on to gains over these last 2 days of 1.8%. Let me just dial it down to today, and you can see we drifted into the red only in the last few minutes there. And then I want to take a look at the small caps. Russell 2000 down about 0.8%, was leading the way down most of the day. And what I was noticing earlier, we're going to talk about this in 30 minutes, Josh, was the dollar was a big decliner today. I think that factored into a lot of things, and that was after a huge up day on on Friday. But here we're taking a look at the sectors, and you can see energy and communication services, XLC and XLE, the only two that finished in the green. What did the worst today were some of the best sectors 1 week ago when we were talking about market rotation again. So today, staples down 1.7%, healthcare down 1.4%, utilities down 1.3%. Then you can throw industrials in there too, although it's not defensive. And you really see this play out in the Dow. And aside from Nvidia, nice day for Nvidia up 1%, and also Nike up 1%. Everything else in the red there. Not the best looking story in the NASDAQ, but a little better because you got Alphabet in there along with Nvidia, and also Tesla up 2%, Netflix up 1%. But I think we're in the case right now. As I said an hour ago, we are in the final month of summer. A lot of people are on vacation, not a lot of liquidity in the market. And so money's just kind of moving sideways into some sectors, out of others. And I wouldn't pay too much attention to the day-to-day fluctuations within a lot of these markets.
All right, thank you, Jared. Bob, sticking with you here, you said something interesting I want to drill into, Bob. You said, we are in one of the greatest macroeconomic experiments in history. How so, Bob? Walk us through it.
Well, when you think about tariff policy, basically what we've decided to do is almost overnight go from largely very minimal tariffs to the highest tariff rate we've seen in 100 years in the world's largest economy. And that is the great experiment. I think there's a lot of folks, particularly in the political realm, who will very confidently state, foreign manufacturers will absorb the tariffs, or certain other people who will say that the consumer is going to get wrecked by the tariffs. And I think any sort of common sense person looking at the situation would recognize there's a lot of uncertainty here. We're effectively adding something like a 1.5% to almost 2% of GDP tax hike on the economy. almost overnight. And where exactly that plays out, how much of it's absorbed by foreign producers versus U.S. businesses versus consumers, it's a real question, and it matters a lot for what's going to transpire for the economy in the second half.
When would we know, Bob, whether this experiment is working? I mean, do we have to give it, is it 12 months? 12 months from now, Bob, you're back in that chair and we're talking, and then we say, oh, well, okay, so we've created this many manufacturing jobs and we've opened up this many new foreign markets to American businesses. Is that when we would know or have some idea?
Well, let's say from a positives on growth perspective, it's going to take a long time. I mean, anytime you see these sort of trade barriers and how long it takes to actually influence domestic investment and manufacturing capacity and jobs, it's going to take a long time. So far, what we've seen actually is things are moving in the wrong direction. And if anything, that's accelerated because the uncertainty related to the tariffs has caused businesses to basically shut down their activity. So you're seeing actually construction spending outside of the AI names falling. You're seeing manufacturing jobs falling. So you're actually seeing real weakness in the sectors that are supposed to be benefited from the tariffs. I think we're going to see, we're already starting to see some evidence about how this is flowing through. Probably the most important thing is it's pretty clear that the foreign producers are not absorbing the tariffs, which means it's coming down to U.S. businesses and U.S. households who are. And I think that difference between the U.S. businesses absorbing it through margins, which we'll see more information about in this week's retailer earnings, versus the households who have to absorb it through prices, higher prices. That's the real question here. And to circle back to the Fed's perspective, to the extent that we start to see more and more pushed onto the households, unless their incomes are growing, that basically means lower real demand in the economy, and that is a real concern for whether this economy tips over in the second half.
On tariffs and inflation, I'm curious then to get your take on what Powell said on Friday in Jackson Hole. He put it like this, you saw this, but to remind the audience, he said, a reasonable base case is that the effects will be relatively short-lived, a one-time shift in the price level. You heard him say that. What did you make of that? Because that almost sounds like you're thinking of it like a bad harvest.
Yeah, I mean, it sounds like it's transitory.
Right.
And, we've certainly learned, you'd think that Powell would have learned, he at least learned not to say the word transitory in his speech. At least that, so that we couldn't make fun of him for it. But the words add up to the concept of transitory. And I think, here I think he's probably actually right, which is that more likely than not, the reason why inflation wasn't transitory in the previous instance was because there was a whole bunch of government transfers that helped support incomes and helped support nominal spending and kicked off a really strong economy, particularly strong nominal growth economy. Here we've actually got a weak labor market, slowing incomes, and then rising prices for consumers. And so it's much more likely that we're going to see this play out with higher staples costs and slower spending on other things like discretionary goods or discretionary services. In that sense, it could actually be, like a normal tax hike. It could actually be demand destructive and disinflationary over a 2-year time frame, let's say, even though sort of the immediate effect is rising prices that consumers pay.
All right. Thank you, Bob. Appreciate it. Coming up, stocks in translation host Jared Blikre. It's going to take us through what typically happens to Nvidia shares after the company reports quarterly results. That's on the other side of the break.
Nvidia is once again approaching record highs after an 8% pullback and just in time for earnings this week. In today's Stocks in Translation, we're taking a look at what tends to happen to the stock historically after reporting quarterly earnings. First, let's take a look at what would happen if you bought Nvidia just before the last earnings announcement and you held for various parts of time here. So we have 1 day, 1 week, 1 month, 1 quarter, and 1 year. So again, you're buying just before the announcement and then you're holding for a period of either a day here, and the median return is 3% for a day, 4% for a week, and 3% for a month. It's not great, and by the way, we're using median for some technical reasons here, but it's very similar to an average. And sometimes the announcement is going to send stocks up, and sometimes it's going to send it down, but when you average it out or median it all out, you don't really see outsized returns until you start holding for longer periods of time. And this is because Nvidia stock has tended to go up over long periods of time. So when you you get to the 1 quarter period, you see median returns of 17%. But what really stands out here is the 1 year holding time, because then you can actually double your money plus. That's 117% return for a 1 year holding time. And this, by the way, goes back 10 years. Now, it's not just median returns that we're looking for. We also want to see what percentage of the time are we right. And so for the 1 day time period, we're right 63% of the time if we're buying. That means that you actually should have shorted about 37% of the time. Then for 1 week, it's 68%. 1 month, it's 60%. This might seem like it's decent because it's over 50%, but in my own personal work here, I like to see a return percentage positive of more than 70%, and that's because stocks tend to go up. So once again, when you get to the 1 quarter period, you're seeing percent positive returns 77% of the time, and then not surprisingly, we see the best with 1 year. That's 83% of the time you would see those positive returns. Now, we have one more chart here. This goes back all the way to the beginning of the century. And let's think of it this way. If you had bought and held for 1 year after each of these earnings reports, this would be your profit and loss over time. So again, you're only holding 1 year, and we've also smoothed this over 10 periods, which amounts to 2.5 years, 4 reports per year. What you can see is we've actually gone negative a few times, so buying and holding is not always the right strategy for at least for the 1 year time period, but starting in 2015 and going forward, we started seeing some outsized returns. And now you can see over the last 2.5 years, we are up over 150%. And of course, this can go down, but it's a good reminder that for buying a stock, and especially if you're not a market timer, best to hold for longer periods of time. Finally, I'm going to close with some statistics here. The first statistic here is derived from the options market. Now, if you're a trader, you want to know, and especially a short-term trader, you want to know how much the stock is expected to move right after the report into the close of filing day, keeping in mind that the announcement comes after the market close on Wednesday. So into Thursday's close, options market is predicting a move of 5.8%. Now, this doesn't tell you which way the direction it's going to go. Could go up, could go down, but that's the volatility, as we like to say. Now, here's what has actually happened over the last 2.5 years. It has gone up or down about 11.8%. So what you might notice is the options market is expecting less volatility than we've seen over the last 2.5 years. And this is because, and it's informed by this statistic right here, the average daily movement over the last 3 months, not including the last earnings report, but going back to late May, it's only been 2.6%. Volatility has really been reined in on the stock, and so expectations for volatility Wednesday into Thursday close, those have also come down. So putting it all together, Nvidia holders, you probably want to hold for that 1 year time or greater. And tune in to the next Stocks and Translation podcast for more jargon-busting deep dives. New episodes could be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcast.
Crypto markets on a wild ride again, going from risk-on mode after Fed Chair's Powell's comments in Jackson Hole on Friday to a rally pullback on Monday. For more, we're bringing in Kavita Gupta, founder and general partner at Delta Blockchain Fund. Kavita, great to see you on set. Let's talk about Bitcoin here, because we had a nice run. We make this big move, Kavita. Now I'm just looking here. I'm back to 110. What is going on there? Explain that to me. Who is selling?
People who bought it at 18K and 20K and 30K.
Yeah.
It's already like, if you look at just 1 year data, you move from 33K to all the way to 110, 120, 125. Of course, there are going to be some sales.
Do you see this as sort of, all right, we're just consolidating here, and then we're going to make a move higher into year end?
Absolutely. I mean, Michael Saylor just announced that they went on and bought another 62K Bitcoin. We also going to see a lot of people following, and also the late catch-ups, all your institutional adoption people, they now have to come.
You think what moves us higher is it's institutional demand, it's generally friendlier regulatory backdrop, that's what moves us higher?
All of them plus digital asset treasuries. Like there are over 4 big Bitcoin digital asset treasuries raising over $1 billion, coming and buying from the market. Absolutely institutional adoption from all over the world, not just US, but also US. Every top bank which has shut down Bitcoin Ethereum, Solana, etc., are now telling their private wealth managers are going to the clients and asking them to put 10% minimum into the crypto. And of course, the whole market regulation is so pro-crypto in today's market. Companies like Square, companies like Robinhood, etc., not only thinking about trading Bitcoin and other crypto, but also thinking about mining. And I feel like those are the big ones which moves the curve.
Bob, I want to bring you in here. Here's a simple question, Bob. Maybe I'm a simple person, so walk me through this. What is Bitcoin? Like if you're at a barbecue and you're talking to your friends and family, they say, Bob, what is Bitcoin? Because you call it a cryptocurrency, but it's not being used as a cryptocurrency. I've heard very Bitcoin bulls, including some very smart folks who made a lot of money, and they'll say, I'll tell you what Bitcoin is. It's digital gold. Don't overthink it. That's what it is. Do you agree with that?
Well, I think that the answer to that question is just empirical in nature.
Yeah.
So if you look at how it trades from a macro perspective and you see what are the factors that are driving it, what you see is it looks basically nothing like gold and a lot like risky assets. Often can be leading, whether it's Bitcoin or if you get sort of out the curve in terms of the greater and greater meme coins, they're often some of the most liquidity sensitive assets that are out there. And so they trade closer akin to stocks. There's a reason why we basically saw, Bitcoin and stocks reach all-time highs roughly at the same time. And if anything, that's actually interesting because if you think about it more like a liquidity barometer than you do think about it like digital gold, it's interesting to see this sort of market action in things like Bitcoin. Maybe it's pretending a bit of a weaker risk asset environment ahead.
What do you make of that, Kavita, that thesis?
I always think that Bitcoin is definitely digital gold. The perspective is the way you have gold commodities, that's what Bitcoin has become for a lot of people. You just asked me, who is selling this? These are the people who are buying and actually having commodity speculations and holding it and selling it. At the same time, when you look at ETH and Solana, I always say they are digital oil because they are the gas fee to actually run that big blockchain ecosystem, all the products which are built on top of it. For an example, the new multi-billion, about to be trillion-dollar market is tokenized assets, which most of the biggest banks are trying to do. And all those tokenized assets are built on either Ethereum or Solana, which basically burns ETH and SOL. And so we also saw on the weekend a big ETH rally, almost about to touch 5K, which is an all-time high for ETH, but just shy of it at 4,900 something. And I do feel that as this September comes in, more people come back from vacation, we're going to see a big rally around it.
Katie, you mentioned Ethereum. So they're big move, pull back. You do have these Ethereum treasury companies.
Yes.
Do you think, for one, I'm just curious to get your thoughts about that trend and theme. And secondly, do you think within those treasury companies, are you seeing maybe the next, you mentioned Saylor, Mr. Saylor and strategy, are we seeing maybe the next strategy being formed here?
Yeah, we already have. We have 4 big companies. There's Sharpling, there is ETHZilla, which just recently went 500. They actually yesterday announced, and just for the context, we are also invested in ETHZilla, but they just went into the market and did another 200 million plus bought of Ethereum. And that buy is a huge number if you're going into the market and doing it. Similarly, there are billion-dollar treasuries on ETH coming out. Solana already has 3 500 million plus treasuries buying it from the market. We have another $1 billion where there's an announcement by Jump, Galaxy, and Multicoin coming together to do $1 billion plus digital asset treasury for Solana to be launched in a week and a half. So of course, all these things goes into the market and create price action movement. But what we really should see is who is really buying into it. These are your retail customers, the new age retail customers, which are people all over the world who may or may not have direct access. There is no Solana ETF, for an example, to have piece into it, but also huge liquid hedge funds, institutions who finds it easy to buy from a NASDAQ listed company than to go into the market and just hold crypto directly.
What about stable coins, Kavita, that trend? How excited are you by it? What do you think the adoption curve looks like there?
It's huge. Like every fintech company, every consumer company, fintech companies have already announced that they are all having their own layer 1 stablecoin systems. But I wouldn't be very, very surprised if every big consumer companies from Macy's of the world to basically Nordstrom or shopping places, Amazon of the world is basically just doing stablecoin, and not only US. We are absolutely underestimating emerging markets from Latin America to Africa to Middle East to India, where your billion customers are going to be paying on stablecoins. But the thing is, it's not only going to be Circle. Circle is predominant today because of their distribution on Coinbase and various other native platforms. But once you have Robinhood, like PayPal has their own stablecoin, tomorrow you're going to have Venmo has its own. You're going to have multiple different, Instagram should have its own stablecoin. You're going to have multiple these stablecoin, but it's going to be a huge institutional and supply chain game.
Finally, Kavita, these crypto-focused IPOs, you mentioned Circle, but there's eToro, there was Galaxy on the NASDAQ.
Yes.
You expect more to come?
Absolutely. I'm looking forward to Anchorage, FalconX, Kraken. A bunch of big companies, multi-billion-dollar private valuation companies are absolutely ready to hit the market between Q4 to Q1 next year. And I think the market is going to be very excited and open for that.
All right, when they come, we're going to have you back on to discuss it, Kavita. Thank you. And Bob, thank you, my friend, for being here the whole hour. Appreciate it. Now time for What to Watch. Tuesday, August 26th. We're going to start off on the economy. Some fresh data on the consumer coming out on Tuesday with consumer confidence. Economists anticipating that number to drop to 96.4 in August, suggesting that households are feeling a bit less optimistic about the economy as consumers continue to navigate a challenging inflationary landscape. Taking a look over at earnings, got some big names in the software space reporting on Tuesday that would include MongoDB, Okta, and Box. Okta announcing results for the second quarter after the markets close. Analysts expecting Okta's revenue growth to slow in Q2 as customer retention fails to keep up with other cloud security companies. And moving over to housing, we'll be getting another read on the housing market with a Case-Shiller home price index on Tuesday. Economists forecasting that home prices are still falling, but at a slower pace, signaling that housing prices are still under pressure, but showing signs of stabilizing. Well, that is going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's asking for a trend.